What's happening, everybody? It's your boy Creative. Go ahead, say it with me. We are back at it again to do what? To create something great. Now, today I'm super excited what I have planned for y'all today. We're going to be going over bid and ask and being able to understand the market prices. So if you haven't already, I need you to go ahead and smash that like and subscribe button. So let's go ahead and jump in. So we're going to be breaking this down into 4 lessons, and after each lesson, we're going to be having checking for understanding to make sure that we are on the same page with regards to what's going on. So lesson 1 is going to be going over bid and ask so we can get a great foundation. So every trade has two sides. There's going to be the buyers and the sellers, right? So when you're buying into the market, you are paying the ask price. So think about it this way. When you want to go over somebody's house, now some people don't do this. They just like to show up. They're like, yo, I'm outside. But like, ask people, ask. But nonetheless, when you're attempting to be able to get into the market, right, you're going to be paying the ask price, right? So you're going to ask to get into the market, right? And when you want to get out of the market, you're going to be paying the bid price. So I like to think about it. All right, bet I want to get into the market. I have to ask to get into the market. So I'm paying the ask price. I want to get out of the market. I want to set up a bid so I can get buyers to be able to buy this from me, right? So now I'm a seller in the market. So I'm going to be setting up a bid, and that's going to be the bid price. So the bid is the highest price a buyer is willing to pay. I'll buy this right now. And normally, when you're paying the bid price, depending on how you submit the order, you could be submitting it a market order. So it's the highest. And then we have the ask prices, the lowest price the seller is willing to accept. I'll sell at this price. There's always, the ask is always higher than the bid price. So think of it like a marketplace. Buyers want to buy, I'll pay $100, or I'll pay 99, or even better yet, I'll pay 98, right? And best bid is going to be 100. And then for the sellers, I want to sell at 101, 102, 103, and then the best ask is going to be the 101. So the market shows the best bid and the best ask at any moment. So why does this matter? When you buy, you get the ask price, the seller sets the price. And when you sell, you get the bid price, the buyers set the price, right? So the price gap between the bid and the ask is called the spread. And we'll cover this in lesson 2 so we can really understand the difference between so how does the spread work? So live market data looking at SPY, and SPY is the S&P 500, the top 500 companies within the New York Stock Exchange. If I'm looking at bid right now to be able to purchase SPY, this is the stock price. We're going to be paying the 674.19, and then to sell it, it's going to be 674.17. So there's a 2 cent spread, super tight spreads. The tighter the spread, the easier it is for us to get in and out of an underlying asset. And more on this a little bit later when we go over spreads in lesson 2. And then Apple, everybody knows Apple. In order to get into Apple is going to be 257.89, and then our bid price is going to be 257.86. So you see the spread is 3, and last is going to be the last price that it was actually trading at. So you see that 257.89. And then Tesla, we're looking at, to get into it is 398.94, and then to get out is 398.90. And then you have that spread of 4. So the wider the spread, the more illiquid it is in order for us to get out of that underlying contract. So bid acts as a visual bid. We're going to buy here. And then our midpoint, there's going to be that midpoint price, right? But normally I'm not going to use the midpoint price when you're looking to be able to fill orders, because this is something that's optimistic, right? This is something that's like a fair value, for lack of better words, right? But when you're looking to be able to fill orders, is going to be the ask or is going to be the bid, right? And then the ask is going to be that 674.19. So let's go ahead and jump into our first quiz. The bid price represents the lowest price a seller is willing to accept, or is it going to be B, the highest price a buyer is willing to pay, or is it going to be C, the last traded price? Now I won't be mad at that, but just a little bit more context, we are going to jump into B. So when you buy a stock, you immediately, when you buy stock immediately, you pay, or is it going to be the bid price? Now, we know that bid, if I want to get out, we are buying here, I'm not selling. Is it going to be the last price? Not always, but that can be something you use in your algo or in your buying algorithm, right? To being able to use the last price. That's not always the best thing to do. You're going to be paying the ask price, right? When you're buying a stock. So it is going to be C. So, which is always true about bid and ask. Now, remember, we covered this earlier in the lesson. Bid is equal to ask. Now, that wouldn't make sense. That's a flat market. We'll go over that in a bit so we can actually understand it. Like right now, it is March the 6th. And just looking at the market right now, it's about 3:26 in the afternoon. And the market has about 28 more minutes, 24 more minutes, excuse me, until it closes, 34, excuse me, until it closes. And right now it's on a little bit of a bearish slump. But the market today has been kind of choppy, right? And I'm looking at it on a 1 minute chart, and I'm looking at SPY, the S&P 500, top 500 companies within the New York Stock Exchange. And I'm looking at it with Bollinger Bands, right? And the reason you like to use Bollinger Bands, because this top line represents the overbought line. This middle line is going to be the 20-minute simple moving average, or 20-minute SMA. And this bottom line here is going to be the oversold line. So in other words, whenever we see it here, we see SPY's going into panicking, or for lack of better words, the market is going into panicking because it's the top 500 companies within the New York Stock Exchange. So in other words, you can say that it is the underlying market, and it just touched that oversold line, right? So normally what happens, it goes from oversold back to the average, and then maybe overbought a little bit. Right here, you have an example. It went from overbought back to the average. Now it's going to oversold. So right now it's just deep, a bit of bear one that's going on right now. So we'll come back to this so we can actually use that as part of our lessons. But to come back here, right, to get to our underlying question here, is which is always true about bid and ask. It's not bid is not equal to ask. No, that's a little bit of flat. That's why I went over there. I want to show you that's not a flat market, right? Ask is higher than the bid. Now, I think I heard that before. Or is it bid is higher than the ask? So it's going to be the bid is higher than the ask. So let's jump over to lesson 2. Lesson 2 is going to be the spread. Now, what is the spread? The spread is the difference between the ask and the bid. So for an example, we had the bid of $100 and then the ask of 105 cents. So the spread is going to be the bid minus the ask, and we're going to get the 5 cents. So this is the cost of trading. So buying at ask and then selling at bid, you lose 5 cents per trade right away. And this adds up when you're option trading, right? Because for every one option contract equals 100 shares. So that 5 cents easily turns into $5, right? Because it's per share. So tight spreads versus wide spread. So a tight spread, it's good for traders, right? Because we have high liquidity. And what does high liquidity mean? We have a lot of buyers and sellers in the market. Popular stocks like SPY, Tesla have high liquidity, right, or tight spreads. It's easy to get in and get out of the underlying trade. Wide spreads are very costly for traders, right, because there's low liquidity. There are few buyers and sellers that are in the market, small stocks and options, and normally after hours you're going to see wide spreads, and it's harder to be able to trade profitably when you're using wide spreads. What affects the spreads? So tight spreads is high volume, market hours between 9:30 and 4 p.m., large cap stocks, calm markets or low VIX, and VIX is the volatility index. VIX allows us to be able to gauge how volatile the market expects it to be, right? So right now, VIX has been kind of popping lately. I'm not going to hold you. Like if you want to take a live look into VIX, and VIX and SPY has an inverse relationship, and I'm kind of glad that I'm bringing this up. So like VIX right now is 28.31. So you see VIX is kind of trying to go to the moon, right? And you see SPY is struggling. So VIX and SPY has that inverse relationship. When you see one go up, you're going to see the other go down. So right now with VIX being at 28.19, that's letting me know that the market is expecting something very volatile to happen within these next 30 days. And it's kind of been like that this entire week. I think VIX has been averaging like 25, like as high, I've seen it as high as 29. I'm not going to hold you earlier today. So VIX has been kind of popping. And if you want more on VIX, we do have a video on VIX in the KreativeU channel here. But nonetheless, as we can see, VIX is popping. So when you see VIX up like this, it's normally going to hurt SPY, and it's also going to hurt QQQ. QQQ is the top 100 tech companies within the NASDAQ. So it is kind of bleeding a bit when it comes to that. So the market right now is not calm. The market is a bit volatile right now because VIX is elevated. So it is not calm. It is elevated. Volatile markets, right? That's where we're going to see those tighter spreads. And high open interest. And open interest is letting us know how many individuals have that particular option contract open, right? Wide spreads, we're going to see low trading volume. This is pre and after market, small cap stocks, volatile markets. How you know you're in a volatile market? I just showed you VIX right now is at 28.33. Right, with VIX being that high, we are definitely in a little bit of a volatile market, and illiquid, letting us know it's not as easy to get in and out of that stock. So a live look at our spreads. So we're looking at SPY. Spread is super tight across the board, and that's a good thing, right? Because it's good for us to be able to get in and out. So we talked about SPY. We know QQQ is the top 100 tech companies within the NASDAQ. Then you have Apple. Then you have IWM, right? So if you think about it, SPY is the standard, right? When it comes to just being able to understand the market. QQQ is the 100 tech companies, right? So some companies that are in QQQ are going to be in SPY. And then we have IWM, which is the top 2,000 small cap companies, right? So small cap is going to be a little bit more risky than when it comes to QQQ, because QQQ, even though it's in the tech sector, these are a little bit more established tech companies. Whereas IWM, you're going to have a little bit more wider spreads, right? And then Tesla and Apple, we all know about them. All right, so if the bid is $50 and then the ask is 50.10, right? What is the spread? We all know, so it's going to be 50, right? So let's go back to our board here, right? So let's get our question. Beautiful. So it's going to be ask minus bid equals spread. So we have our bid, right? Bid equals 50. Ask equals 50.10. Right? Now what we're going to do is 50.10 minus 50 equals 10 cents. And this is our spread. Kind of wide. I'm not going to hold you. Kind of wide. So let's go back to our question here. So now we can see which way is the right one. It is going to be B, right? Kind of wide. I just from that, it's a little bit of a small cap company, a little bit illiquid. It's depending on how you trade it. Would make sense for you, but skew. All right, let's go to question 2, which is a stock with a tight spread typically has low trading volume. High trading volume. I think I've heard that before. No buyers. That's kind of crazy. So it is going to be high trading volume. When would you expect wider spreads? During market hours on SPYs, depending on when, right? But that's not the good answer. There's a better answer. Pre-market on small cap stocks, or a midday Apple. So you're going to expect it, and it is going to be B. All right, so let's go ahead and jump into our lesson 3. It's going to be size and liquidity. So bid size is how many share buyers want at the bid price, and then ask size is going to be how many share sellers are offering at the ask price. So an example would be everybody who wants to get out at 100 times 500, or is it going to be 500 100 times 5 times 300. So 500 shares wanted at $100, and then 300 shares available at $100.05. Why this matters: the larger the size is going to support our support and resistance levels. Now remember, we kind of talked about this before, and I want to get this up. Give me 2 seconds because I have this amazing little graph that really breaks down support and resistance so we can really understand how it works here. So 2 seconds, fam. Here we go. Not that. I want this. All right. So this is SPY, right? So SPY has been going crazy, for lack of better words, right? Our support is going to be the bottom, right? Our support is going to be the lower lows, right? So normally, you ever heard that adage, you buy low? So you're going to buy at the support levels when the underlying stock price goes through the lowest low, right? And then you're going to sell at resistance levels. Resistance is going to be the higher high, right? So we're going to buy at support and then sell at resistance for the higher high. Now here, when it comes to being able to understand the size when it comes to the bid and ask, this is going to support our support or resistance levels. Now a bid, somebody that's trying to buy 10,000 shares at 100 or sell 200 at, 200 shares by 200 shares at 105 for the big size equals lot of buyers waiting to support. The small axe is a few sellers that could easily move up. So large axe size is resistance overhead. So the small bid size equals weak support, could easily drop. And then the bid size is the wall of sellers, a resistance. So this is being able to understand the difference between the two, right? How the 10,000 when it comes to the axe is going to be supporting our resistance, and then the 10,000 when it comes to the bid is going to be supporting our strong support levels. So liquidity is how easy it is in order for us to buy and sell without moving the price. High liquidity is tight spreads, larger bid ask sizes, and high daily volume. We can easily trade large amounts without impact. Low liquidity is going to be wider spreads. This is going to be with smaller bid ask sizes, and then low volume, your order might move the price against you. So live look in at SPY, right? We have individuals that want to be able 76 million that's in the volume right now that's been traded, 22 million for Apple and 73 million for QQQ. SPY and QQQ are ETFs. These are exchange traded funds, right? So think of it like 100 of the top tech companies that's in QQQ and 500 of the top companies overall that's in SPY, and then Apple is just the only stock here. So as we can see, the size of it is being able to push our support levels, our resistance levels here. No, excuse me, support levels here, resistance levels here, and then support levels here, right? Just being able just to understand it just based off of the size, right? So SPY is there's more buyers than sellers at the current price. So being able to let us know that they're trying to hold on to the support levels, right, and not have it go down any lower while they're pushing the price up. So let's look at it. Take a live look at this, right? So we looked at SPY a little bit earlier, right? This is dope because we're seeing it live. So green candle represents the buyers, or is going to represent everybody that is on the axe price, right? These are the individuals that want to push the price up. So we're seeing that right now that they're defending the support levels, right? And they want to be able to push against the resistance levels. So this is a live look at it. And then the red candles are going to be individuals that are asking, that want to be able to get out of the market. So these are going to be the sellers or the bears. So you see how it just flipped from green to red. And I'm looking at the 1 minute chart. So a little bit noisy, but not that much, right? And the reason I like to use the 1 minute chart is because I like to see just a little bit more action going on intraday as opposed to the 5 minute. There's nothing wrong with being able to go to a higher time frame, but I've just gotten used to the 1 minute. So that's what all of my strategies, and that's how I just read the charts from now on. But so right now, the market is going okay, it is pushing past support. And you saw how it just went from a doji. Now it's a big body candle, but there's a little bit of rejection that's coming here. And the reason I'm seeing the rejection are these wicks, right? So they're trying to push it past this resistance line, right? They're trying to push it. They're at support. Now they're trying to push it to resistance. So let's see if it could push to resistance. And I think they're almost there, right? And once they push it to the resistance line, now they can be able to see if they're going to hold it. But nonetheless, let's go back to our quiz. It's just always nice to take a look into there. So we have a bid of $50 times 1,000. What does this mean? 1,000 shares for sale at $50. 1,000 shares are wanted at $50, or the spread is 1,000. So remember, bid, you want to get out of the market. So there's going to be 1,000 shares that are for sale at 50. That's awkward. I typed the wrong button. So a stock with a high liquidity typically has tight spreads. Beautiful. Now, if a bid size is 10,000 and the ask is 100, this suggests that there's strong selling support, that strong buying pressure and support, or the market is closed. So, all right, bid, bet. These are individuals that want to get out of the market, right? So there's going to be a lot of strong selling pressure that is there. Goodness gracious. All right, so using bid asks for better trades, right? So market versus limit orders. So a market order, you want to be able to buy and sell right now at whatever the price is, guaranteed executions, but does not guarantee the price. You pay the ask or you get the bid, right? When to use, when speed matters more than price. So limit orders is only buy and sell at this price or better, right? So you control the impact of slippage and spread a little bit more with the limit orders, right? Guaranteed price as opposed to guaranteed execution does not guarantee the execution. You get the price you're willing to pay when the market moves, use when the market price matters more than speed. That's when you want to be able to use. So slippage, being able to explain, slippage is the difference between what you expect and what you actually get filled, right? So live example is that you buy at 105. This is the ask price. You see 105 times 100 shares. Your order 500 shares with a market order. First order gets filled at 105, then you go up a level. It's like up 10 cents, then 5 cents, right? So average slippage was 6 cents. Average cost was $100.11. How to minimize slippage is to trade liquid stocks with large sizes. Use limit orders instead of market orders. Trade during market hours, or don't trade more than the visible size. So smart strategies to hit the ask is the bid is at 100, ask is at 105. You buy at 105, guarantee fill, but you pay more. Bid at the mid, I wouldn't even say this, right? Because at times you're not going to get filled at the mid, right? You may or may not get filled, and it's going to split the spread. So it's a great strategy, but I wouldn't always recommend being able to bid at the mid, right? Or wait for the bid, be patient. Best price if it fills, but might not execute. So here's a live example at different SPY scenarios. The current price is 673.05, and VIX right now is 28.38. Okay. 673.35 for the bid, ask 673.07. The spread is going to be 2 cents. You want to buy 100 shares, market order is going to be $63,307. At the bid is going to be $1 less, or limit at the mid bid is going to be $2 less, right? If it's filled. potential savings, but this is like super aggressive, being able to, you want to buy shares and you're going to place it at the bid. Super aggressive, right? So you're normally going to place those shares at the ask. You can place it maybe a cent below, right? But being able to place it at the bid, I mean, normally I just go straight to ask, right? Submit my limit order to ask, but you can do it at the bid, but doesn't mean you may fill it, right? So you may save 2 cents. Why not just submit it at the ask, maybe 1 cent less, since the spread is already 2. So potential savings is at the bid or the mid, but again, that's if it gets filled. Market order guarantees execution. Let's see if we can get 3 out of 3 this time. I'm only human. I'm a man. I make mistakes. Yeah. Slippage is more likely when SPYs trading during market hours. Not really. Using limit orders. Not so much. Trading illiquid stocks with market orders. Beautiful. To get the best price when buying, you should always use market orders. Not so much. Place orders at or near the bid price. Again, I have my thoughts about that. And then trade after hours. No. Right. So just by process of elimination, we're going to do that. And we did get it right. So it's 10 out of 3. Bet. So again, I do appreciate y'all for sticking by. If you did enjoy what you've learned today, I need you to go ahead and smash that like and subscribe button. It is your boy Kreative. We'll be back at it again with another episode.